So last class we had started off with one of the major important components of financial system, financial service. We looked at the meaning. We looked at 5 features of financial services. We understood the bifurcation of financial services is on 2 bases. One is fee based and one is asset based. Last class we have covered the fee based services, merchant banking, credit rating, stock broking, and merger. These were the 4 topics we covered yesterday, last class. Today let's begin with the second aspect or the second basis of financial services, asset based services. Let's look at the meaning. It is a specialized method of providing companies with working capital and term loans that use accounts receivable, inventory, machinery, equipment or real estate as a collateral. It is essential any loan to a company that is secured by one of the company's assets. Now remember, fee-based services means what? You are giving or you're charging fees based on the services that you render. Okay, it can be merchant banking, you're giving a service and you're charging fee for it. But asset-based services is opposite. Having asset, right? Having any kind of asset in use. It can be in terms of leasing or hire purchase or financial documents like bills of exchange, otherwise called as accounts receivable. Based on this, the services are provided. Understood? That is about the service, this is about the asset. Okay, I'm providing a financial service based on an asset. That asset can be a financial document or a paper like accounts receivable. So every time there's a sale credit, have you come across bills receivable, bills payable, right? Those are otherwise called as accounts payable and accounts receivable. What is inventory? Inventory is your stock or work in progress in your company or in your godown. Machinery is otherwise called as asset. Equipment is also an asset. So any kind of service you are rendering based on an asset belonging to the company is called as asset based services. So the first type of service today we're going to learn is asset based leasing. Okay, now if you can look at the picture, one equipment or one machine is ready for purchase, one equipment is ready for rent and one equipment is ready for lease. And you can see the size of the machine that is left for lease is a bigger or a larger machine or an equipment or a vehicle compared to the other. Let's look at the meaning. What is leasing? Leasing is an agreement that provides a firm with the use and control over the assets without buying and owning the same. Notice that word, you can use and control but not buy or own the same asset. Now we can see here this example, that big asset which you can see towards your right is meant for leasing. So it's such a big vehicle or an equipment, if I as a company, I am not able or I don't have enough financial budget to purchase it, but my company requires the usage of that particular equipment or a machine. So instead of buying that asset because I don't have sufficient funds with me, I would take up this option called as leasing. So I will take this equipment for lease and just use it. Okay, I don't own that asset, but I only have control over that asset. Okay, I can use this asset, make profit or make money out of that asset and then return that equipment back to the owner. So as I was explaining, what is leasing? Now here at this picture that we can see, my company or the owner of the company does not have enough funds or financial budget to purchase this heavy equipment. So usually what I do is I try to lease it out. So then what is the benefit if I lease it out and not purchase it is, I can save that huge amount of money, right, instead of purchasing, and I can only pay the fees for using that equipment or that vehicle. Okay, so I can use that or I can take any kind of benefit that I can derive from the machine and then make money, and once I've completed with the usage of the machine, I can return it back to the owner, because I do not own the asset. I only have the rights to use that asset and not own it. Therefore, leasing is an agreement that provides a firm with the use and control over the assets without buying and owning the same. Hope you have understood the first point, leasing. Your second asset-based service is hire purchase. It is called as an installment plan. It is an arrangement whereby a customer agrees to a contract to acquire an asset by paying an initial installment and repays the balance of the price of the asset plus interest over a period of time. Now, if you can see the name itself, hire purchase, that means what? Under this plan, the customer is trying to purchase a particular asset. Notice these words in the meaning. In installment plan. Second, acquiring an asset. Third, initial installment. Fourth, balance of interest plus the price is paid over a period of time. Okay, these are the 4 keywords that you need to notice. What is hire purchase? Payments will be made in installment. Okay, that installment, now remember, let's look at this car. Now, if you have to own this car, or if you're planning to purchase this car on hire purchase basis, or any kind of equipment or asset for that matter, hire purchase is one shot, I do not have the budget to purchase. Is that clear to you? Even under leasing, I do not have enough budget to purchase the equipment. Even under hire purchase, I am not having enough budget to buy the particular asset or equipment. But instead, what will I do? I am ready to pay in installment basis rather than one shot payment. Understood? So, hire purchases, I take first the initial deposit. Okay, I make an initial deposit, then I periodically pay my installments, which is consisting of my principal payment along with interest, and in the last payment, last installment, I own that particular asset, or I will own that particular car or an equipment. For an example, let's say the equipment cost is rupees 1 lakh. The equipment cost is rupees 1 lakh, okay? And the interest, definitely, if I'm paying one shot for the equipment, then the seller will charge me only rupees 1 lakh. But if I'm asking him, I want to buy in installment plan, basically hire purchase system, then he will tell, let me charge you an interest on rupees 1 lakh. Let's say he charges another 10,000 extra. So the total purchase price became 1 lakh plus 10,000 interest. So he says first he asks me to pay first a down payment, a deposit, otherwise called as initial payment. So I make my payment initially, let's say rupees 5,000. Okay, then periodically the rest of the amount, 1 lakh 5,000, he's going to divide, let's say, into 10 investment or 10 installment periods. I repeat, the entire purchase price is 1 lakh plus 10,000 rupees interest. I pay a down payment or initial payment of rupees 5,000. So 1 lakh 5,000, I am going to divide it by equal of, let's say, 10 equal installments. Then I continue to pay, and in the last payment, I become the owner of that asset. There might be a question, what if I fail to make the payment, right? Let's say out of 10 payments, I have made 8 payments honestly, okay? I have paid it, there is no any backup, any default in the payment, I have paid it. And then what happens? Even if one payment is left out, the owner or the seller can take back the equipment or the asset from us. Understand? If I am willing to buy on hire purchase, I should be willing to pay even until the last installment plan. Even if I back out one plan or one payment, the owner can take back the asset. Is that clear? So what is hire purchase system? The payments will always be made in installment. It is not a one-shot payment. It is by installment. Second, the possession of goods is given to the buyer immediately. So the moment I pay the down payment or initial deposit, the seller is going to give me the asset, the possession of the asset. Third, the ownership rights remain with the vendor till the last installment is paid. Okay, so even though the possession is with me as a buyer, I am not the owner of the asset. Okay, ownership rights will remain with the seller or with the vendor until the last installment. Next, the vendor can repossess the assets in case of default of payments. As I told, even if one payment is not paid or there is default in the payment, the owner or the seller can take back the asset anytime. The installment include interest and principal. So every installment that you pay, it will be a combination of both principal amount and interest. Hope you have understood what is the meaning of hire purchase and the steps listed down over here. Let's move to the third point. It's called as consumer credit. The name itself, remember, consumer means what? What items or what food items that you consume, means eat. Okay. Consumer credit means what? It is a type of financial service where credit is given for the purchase of household items. This concept of consumer credit is not in practice today because of higher standard of living. So this consumer credit, have you heard anywhere right now? No, definitely not, right? It was a very old concept where back then people didn't have a very good standard of living, where people couldn't afford the basic necessities of life. Okay, that time this concept was very much was very much popular in in our economy. So it is a credit given or available to people or consumers to buy essential needs of home or household items for consumption. Understand? Consumer credit is a credit given to buy certain items for consuming or for household items. Today you will not find this item much because no more do we need any more credit for buying our essential items. No, today all of them have basic job or some basic decent salary, so we can buy our own essential items or our own essential household items. We do not have to take a credit just to make sure to buy household items. Hope you have understood the third one. Moving to the fourth one is called as bill discounting. I am sure you have heard this word even in your PUC, right? Bill discounting, bill of exchange, bills payable, bills receivable. Let's look at the meaning. Bill discounting is an arrangement whereby the seller recovers an amount of sales bill from the financial intermediaries before it is due. Such intermediaries charge a fee for the service. I'll explain this concept through an example. Now look at this example. The buyer has purchased goods from the seller. Understand? The buyer has purchased goods from the seller and the buyer says, let's say the entire bill of that goods is ₹1000. And he says, I am not able to pay you the full amount right now, but please give me 3 months time. I will pay back the amount within the due time. The seller is going to agree and he will sell the goods at credit. Always remember, a bill of exchange or accounts receivable will only come into picture when there is credit sales. Understood? Whenever there is cash sales, I don't have to remember from whom I have to receive money. But if it's a credit sale, I need to remember from whom I should recover the sales. Got my point? So bill of exchange comes into picture only when there is credit sales. That means you take the goods now, but you pay the amount later. That is called as credit sales. So the seller agrees to the buyer, okay, you pay me after 3 months, and he draws a bill, which is called as bill of exchange. He states that Mr. So and so has taken goods from me on this particular date. This is the good quality, this is the good price, and this is the good features, etc. And he has promised to pay me back within 3 months time period. The total bill of the goods is rupees 1000. So both the signature will be there, the buyer's as well as the seller's signature. He is going to make 2 copies of this. So one the seller will keep, because seller has to receive the money from the buyer. Seller has to receive the money from the buyer. So seller will have accounts receivable, otherwise bills receivable. On the other side, buyer is going to have another copy of bill of exchange stating that it is called as bills payable. Because why? Buyer has to pay 1000 rupees to the seller. He does not have to receive, he has to pay the amount. So for buyer it's going to be bills payable, and for seller it's going to be bills receivable. So what exactly is bill discounting is? Now let's say the seller is in need of that 1000 rupees. Now let's say the bill is dated on Jan 1st, 2020. So 3 months from down the line means Jan, Feb and March 31st. So basically the bill of exchange will mature on which date? 31st of March 2020. Now the seller immediately he has some emergency or he has some requirement of that 1000 rupees of amount. So can he go and demand from the buyer the 1000 rupees? No. Until March 31st, he cannot go and demand the buyer to pay the amount of money. Even though he is liable to pay, he cannot demand because he still has time until March 31st. What happens to seller? Feb 1st, he has an emergency and he desperately needs money. Now he has only one option to go to the buyer, which is not possible. The second option that seller has is discounting of bill or bill discounting. So he straight away goes to the bank. Okay, the seller straight away goes to the bank and he says, see, I have a bill of exchange which I am going to receive on March 31st. It is due by March 31st, but I need that money right now. So bank will tell, okay, I will pay to you the amount of money in the bill on behalf of the buyer, but I'm going to cut some charges. Understand? Because bank is honoring the bill on behalf of the buyer even before the bill is due. Understanding? He is going and presenting the bill on which date? Feb 1st. Therefore, bank will say, since I am paying you even before the due date, I would like to cut some charges. So, the seller is like, okay, done. So, bank is going to give him, bill is how much rupees? 1000. Bank is going to deduct a discount of rupees 100 and pay rupees 900 to Mr. Seller. Next, on March 31st, what happens? So, initially, bill of exchange was between who? The seller and the buyer. On Feb 1st, once the seller has received rupees 900 from the bank, he is no more a part of the bill of exchange. Then, whom is it addressing to? Now, the bill of exchange will focus on the bank and the buyer. On March 31st, the bank is going to present this same bill of exchange to the buyer. And then bank will recover the full amount, rupees 1000, not 900, remember, rupees 1000 from Mr. Buyer. Understood? This entire process is called as bill discounting. So you remember this word? Bill discounting is an arrangement whereby the seller recovers an amount of sales bill from financial intermediaries before it is due. Such intermediaries charge a fee for the service. So I am just refreshing over here, recalling the example. Buyer buys the goods from seller on credit and agrees to pay it after 3 months. But seller has an immediate need of money on a particular date even before it is due. In our example, the 3 months starts from Jan, Feb and March. So the seller wants the money on Feb 1st. He cannot ask the buyer, so he goes to the bank, displays the bill of exchange and the bank agrees to honor the bill even before it is due. Therefore, the bank will charge a fee and deduct rupees 100 from 1000 and pay rupees 900 to Mr. Seller. And then on March 31st, when the bill is maturing, the bank is going to present the bill to buyer and recover the full amount of the bill, rupees 1000.